Okay, so you want to start investing and you're not sure how to pick your first stock. Well, I can tell you one thing, it's probably not going to be on YouTube. Hey guys, I'm Kylie, and in this channel I'm going to be breaking down the basics of investing so that everyday people can make a return on the dollar. Plus I'll be sharing my investment journey as I keep learning along the way. And just on a side note, I've been a financial journalist and content creator for over 10 years now, but I am not a financial advisor, so don't take any of this as personal advice. So in this video, I'm going to talk about my first stock market investment, why I picked it, and some of the lessons that I learned from that. Plus, I'll be talking about how you can pick your first stock. Stock market investing is just one type of investment. There are many ways for you to invest your money, from putting your money into a high interest savings account so you can get a very small return on the dollar, to investing in an ETF, there's gold, there's topping up your retirement fund, which is called superannuation in Australia. Buying and selling stocks is just one type of investment, and you should really consider whether or not it's the best investment choice for you. You should also think about what your risk profile is, and that means whether or not you can take on that type of risk. Can you afford to have your money invested in a stock for long enough to see gains? So anyway, it was a few years ago now when one day I decided to finally take the plunge. I already had several online brokers that I used to gather information for writing about the stock market, but trying to decide my first stock pick was a really hard one. I ummed and ahed about it for such a long time because I just couldn't decide on which stock to go with. You know, do I pick a blue chip stock like the analysts are always talking about? Do I pick a dividend stock? I did so much research, and in the end I ended up like a lot of you guys did, and on YouTube. And the funny thing is, you know, at this point I'd interviewed so many analysts, I knew that you weren't meant to take stock picks off YouTubers. It's like rule number one. But of course that's exactly what I did. I ended up scrolling through hours of YouTube video and finally landed on some teenager who picked a stock for me. And the stock that I ended up going with was called Pilbara Minerals. It's an Australian company stock, and it's a lithium miner. And I brought in at 0.78 cents just as it was heading up. It was an exciting time to be in lithium stocks because, of course, there was a lot of talk about this electric vehicle revolution. And to be honest, I was actually caught in the hype myself. I was writing about lithium stocks a lot and writing about the future of lithium vehicles and about Tesla. This went against every rule that I'd been advised by analysts, but I thought, nah, I want to go with something interesting. Within 4 months of me purchasing the stock, the price had risen by 48%. So that was 4 months of me patting myself on the back and telling myself I'd done a really good job. And I think that's exactly what a lot of new investors will be doing after the last 12 months or so. A lot of people invested in stocks for the first time during the March market crash last year. Of course, my jubilation didn't last very long because within 4 weeks of it reaching its peak, it soon crashed by about 30%. From that point onwards, it was basically just a downward spiral until it hit its bottom in around February of 2020. So from the point that I bought it at 0.78 cents until about March 2020, it had fallen by more than 80% and reached a bottom of around 0.15 cents. So at this point, I'd pretty much just given up on this stock. And I'd kind of written it off as like that's my first stock, what do you expect? Volatility, it's one of those big life lessons. That being said, lithium stocks are again one of the most talked about, and in fact, since the bottom of the market, that stock has gone up by more than 1000%. The funny thing is, it's actually become one of my best performing stocks, in fact, my best performing stock in my portfolio. I think lesson number one is kind of obvious. When it comes to investing in stocks, don't sweat the small stuff. Ignore the volatility.
Who cares?
Stock prices will always go up and down. What's most important is the long-term trend. You know, for example, if you'd bought Amazon 20 years ago, by September of that same year, the stock price would have fallen by 60%. If you'd ignored this decline and waited for just a few more months until November, you actually would have seen its stock price jump by 60% since the time that you bought in. And if you'd still had the stock today, your stock price would have been up by over 23,000%. So it pays to remember that you don't actually lose anything until you cash in that money. So if the stock price has fallen and you decide to cut your losses, then you are locking in those losses. You don't get a chance for that stock price to go up again and to even go, you know, perhaps beyond what you first paid. The second rule would be don't invest more than you can afford to lose. It's really hard to predict what stocks will do in the future. Even the experts get it wrong a lot of the time. In my case, I invested in a lithium stock, which I knew at the time was pretty high risk, but I'd only invested $500 into it and I knew I could afford to lose that. If, on the other hand, I'd invested all of my savings into that one stock, I would have had to wait, several years for me to get that return. That being said, what an opportunity, because it's gone up by more than 1,000%.
We have liftoff.
Third bit of advice is if you're looking for a stock to buy, don't take a stock pick from a YouTuber. Or at least, if you do take a stock pick from a YouTuber, do all the research yourself and really understand what the company is about, what the risks are, and whether or not it has solid growth trajectory. We actually did a survey recently at Finder asking people why they picked their stocks. 12% said that a friend or family member told them it was a good investment. That's a really common one as well. Look, your friends are talking about it, your family's talking about it, you're hearing people talking about a stock. It gets you thinking, is this a good investment? The same as taking tips from a YouTuber, you're taking tips from family or friends. Do your research yourself. Don't just trust what they're saying, because they might just be repeating what other people are saying.
10,000%. That's how much this sector is about to grow.
I'm not actually against looking up stock picks. I think it's a good way to get ideas so that you can do extra research yourself. And according to the survey, 14% said they invested in a company because they liked the product that the company is selling. That's actually really common advice from analysts, and even Warren Buffett himself has said it. Invest in a company that you know and that you use yourself. So for example, if you're on Facebook all the time, invest in Facebook, because you'll be the first person to understand if the company is suddenly not doing well by its customers.
I have an old-fashioned belief that I should expect to make money in things that I understand. What they do, I understand the economics of it, I understand the competitive aspects of the business.
Of course, not all of these stock investments worked out. A lot of people lost money. Others that held onto stocks for a long time have seen a great return. I think my final lesson in all this is not to worry about what your first stock investment will be and just dive in and make some mistakes. You don't have to invest $500 into the stock market. You can invest from as little as $10. A really important lesson in investing in the stock market is that there is volatility, that you'll see your stock prices go down, and a real learning experience just to learn to deal with those losses.
You've got to be willing to crash and burn. If you're afraid of failing, you won't get very far.
I've seen so many people invest for the first time from March last year, and so they've absolutely seen their stock prices go up and up. This can't go on forever. I can only imagine that if I'd invested for the first time and subsequently seen my stock portfolio go up by so much over a pretty short time frame, I'd be feeling pretty confident. I do worry that some people haven't had the experience that you'd normally get when you buy a stock, which is to see the price go down at some stage. I think that a lot of people will probably be in for a bit of a rude shock when prices do suddenly crash.
Oh my God! Okay, it's happening. Everybody stay calm.
Okay, so if you've decided you want to invest in the stock market, how do you pick a stock? That's a really good question, and it's not super easy to answer because, even the experts get it wrong a lot of the time.
Hard!
Just as one example, Warren Buffett, probably the most renowned investor in the world, turned his nose up at the Facebook IPO, and he stuck by that. Over the years, I've asked this question of a lot of analysts, and they tend to have the same advice. That being said, it does differ from analyst to analyst, so you can take it with a grain of salt. Probably one of the most common themes is to invest in a company that has long-term sustained growth. One fund manager that I interviewed, his name is Roger Montgomery, he said that he looks for companies that have a sustainably high rate of return on equity. And he says that's because a company that can sustain these high returns usually have a sustainable competitive advantage. Having a sustainable competitive advantage is a pretty key thing. Like, were they first to market? Do they have an impressive product that no one else can get into? One company that I invest in that does have a very sustainable competitive advantage is CSL. CSL is an Australian blood plasma company. The reason I invest in it is because it's the biggest in the world for that area, and plus the barrier to entry is really high. The same can be said with a lot of mining companies. Even though mining companies are very volatile, the barrier to entry is high because it costs a lot to get all the equipment, it requires engineers, there's a lot of expertise needed. Roger Montgomery said the most valuable competitive advantage is the ability to raise prices without a detrimental impact on unit sales value. So medical companies are a really good example of this. They're providing a product that people need, and they usually have a patent on that product. You know, another example of this is Tesla. People either love Tesla or hate Tesla. One thing you can't deny is the cutting edge technology. Yes, it's a leader in the electric vehicle space, but also probably more importantly in the energy storage space. So how do you measure all of this? Well, there's a few ways that you can think about it. There are PE ratios, profit to loss statements. There are a few equations that you can use to look at this, but you should also take these with a grain of salt. One of them, and probably the most well-known one, is the price to earnings ratio. That's PE ratio. That's its stock price versus how much it's earning. The reason I say to take this with a grain of salt is because, you know, market sentiment is a very powerful beast. You know, the price to earnings ratio of something like GameStop would be through the roof at this point, but, you know, that might not matter to some people. Another famous example of this would be Tesla, who wasn't earning a profit until I think it was 2020. Doesn't matter because people are investing in the future value of the company, not the current value of the company. Another pretty simple thing you can think about when you're trying to pick your first stock is blue chip stocks versus growth stocks. Okay, so just very, very simply, there's much more to it, but blue chip stocks are the big companies that you think about, the major banks. They're usually old companies. They usually pay a dividend. So people will invest in these income companies if they want to get dividend paid out for them every year. They don't really care about the growth as much. The company probably isn't growing a whole lot because they're old and they're well established. There's not a lot of growing to do, but they do pay that dividend.
Ooh! Wow!
The other type of company that you'd invest in very loosely would be a growth stock. It's kind of put together as like the opposite of a blue chip stock because often it doesn't pay a dividend. It's not as well established as a blue chip company, which means that it's got a lot of growing to do. Of course, by that same token, it's also a riskier investment because less well-established companies, you know, could go up, but they could also go down. So, you know, Google, Facebook, and Amazon, they were all once growth companies up until pretty recently. These days, they're so big, they're probably not going anywhere. They're more like blue chip companies. Thanks guys, that's it from me. Don't forget to hit the like and subscribe button if you like this video and you want to see more. And I'd love to hear your first stock investment, so please leave a comment in the section below.